What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is December 26th of 2018. Well, folks, I hope y'all are having a wonderful day wherever you are, and today we've got a few key things to discuss here on the daily update. As always, we're going to be spending some time to take a look over cryptocurrency markets. I want to spend some time to kind of talk about the recent pullback we've had over the past day or two, and as to whether or not this was a full-on dead cat bounce, or that we might see a little bit higher levels tested here from the recent rebound we've seen over the past 2 weeks in crypto. And I also want to spend some time to talk about traditional equities, how in Asian markets, for example, to really put a perspective on the bear market we're seeing globally, over $5.6 trillion has been removed from valuations in Asian equities, and that's Asian markets alone. So we're going to be talking about the global picture as a whole as well, and along with that, talking about a key indicator that an economic slowdown might be approaching, and that is the price of crude oil. So we've got lots of things to discuss. Let's not push it off any longer and dive right in to the update. Alrighty, so let's go ahead and take a look here over the past 7 days. It's starting to look a little bit less strong than what we were seeing beforehand as we start to price in the past day or two of price corrections into Bitcoin as we start to approach down, I think, around the $3,700 range. Again, seeing a little bit of correction from what we saw over the past few weeks, bouncing from $3,200. Nonetheless, most cryptos still in the green, but not by a long shot. So as we go over here to take a look at market overview, let's go ahead and take a look at the past 30 days. Again, still, as I mentioned, holding the majority of the gains here, around 30% gains on cryptocurrencies market cap. Again, it's definitely a little bit of a correction, but at the same time, it's nothing like what we were seeing over the past few days. I think we need to apply some perspective here, where we were starting to see some sharp corrections, and volatility is quite low here. I'll explain really what this is, in my opinion. I think that we still have a little bit of room to move up after this sharp correction. I think there's the decent amount of capitulation that we saw over the past few weeks is not going to return just yet until we do get some optimism coming back into price. And I think we could easily test around 4,500, 5,000 on Bitcoin. And that's as someone myself who's not making any crazy new additions at the moment. I've already gotten well exposed into crypto at this moment. And again, altcoins taking a little bit of a dip as well here. But the major thing that I still want to focus on is the fact that Bitcoin dominance is remaining in this low range. Now, we haven't seen a full, complete breakdown of Bitcoin dominance as it was starting to look like we were building up to, with the momentum picking up on altcoins. But again, I'm remaining patient, waiting to see if Bitcoin holds on this key level that we're talking about. And ironically enough, as always, as Bitcoin holds strength, altcoins are going to hold it even stronger. And that's why I believe that we could see a potential rollover of Bitcoin dominance to an even lower level, allowing some of these altcoins to really make some moves here. And again, we're starting to see Ethereum gaining market share back, going from 8% up to around 10%. And again, XRP and a lot of other altcoins that are more on the riskier spectrum, as well as Bitcoin Cash, coming up even in this bear market. So it is very interesting to see that. It's an interesting dichotomy. Now, right now, I'm on the 4-hour chart here, guys, and I apologize. I'm not going to be moving around my my chart for some reason. I don't know if it's something with my computer. I might need to restart it, but my charting software is going very slow. It might just be Chrome eating up on my RAM. But anyways, I wanted to go ahead and kind of lay out what I'm watching on the chart here, and things are kind of playing out exactly in line with what we had in regards to our lines that we were watching for resistance and support. And what's really nice is that Bitcoin has not only gotten past the first line of resistance on the bottom chart, which held down the majority of the downtrend in the later part of November and December. So we've gotten past that, and that's where we saw a lot of gains coming through. But we also were able to break through the resistance mark that was holding down price at the top towards the middle part of November. And it looks like right now we're facing a little bit of a correction, actually looking to see if we can make support on previous resistance. And this is, again, guys, I think it's been very clear. We didn't expect the break on 6K, but one thing we have gotten right in the short term is that these two lines are coming into play. Now, whether or not Bitcoin's going to hold on this, I mean, that's going to have to be a question answered over the next 24 to 48 hours. If it continues to hold on this, as we're looking at the 4-hour chart here, I think it's going to probably retest the level one more time around 3,800, and then from there it's going to be a question of, look, can it pick up momentum? Can it start getting some buyers? And again, we've been seeing more volume candles come in on the buy side, which is reassuring, I think, in this case. I think there's going to be a lot of short-term speculation. You know, with Bitcoin being down so dramatically, going from, for example, 3,200 to 5,000 is a much bigger leap than, for example, 6K going to 7 or 8,000 in this case, percentage-wise. So we want to potentially see some speculators coming in at this range. And if Bitcoin can continue to hold on this line, even though the line is descending, it's making support off previous resistance, which shows strength. And you're going to be getting much more rallies like this if you can do that, if you can break the resistance, make support out of it, as we did over here and as we've been doing over here. So outside of that, there's not any major lines of resistance outside of, horizontal lines of resistance here for previous support in this case that might serve as resistance. So we'll be keeping an eye on those as well. But for now, seems like crypto is just, again, having a slight correction from some of these gains here over the past few days. And it's going to need continued volume. That's the big thing. I don't think we've seen enough volume yet, which is making me feel that we're going to probably test, again, 4,500, 5,000. And then from there, we're going to roll back over and retest those lows. I don't think we've really formulated a full-on bottom to make higher levels in the market, right? We usually see multiple tests on the bottom, but I'm rambling at this point. Anyways, so I'm going to go ahead. I won't be reviewing any altcoins today, guys. We'll go back and take a look over equities in a bit on the chart, but wanted to go here to talk about this article from Bloomberg with 5.6 trillion. That's right. You didn't hear me say billion or million, guys. 5.6 trillion in Asian stocks being lost. So obviously we have to put some perspective here. If we heard this in the crypto space, well, crypto never even reached a $5.6 trillion valuation. So I think that applies some perspective. Since we have seen the peak out in Asian markets back a few months ago, we have been seeing a dramatic correction. And this isn't just in China or Japan or South Korea. This is across the broader range of Asian markets. So it's very easy when you're compiling a lot of economies and at the peak of a bull market to get a figure like this. But 5.6 trillion is substantial in the sense of global equity markets, which still remain, I think, from what I last checked, was in the double-digit range for global markets. So to still see 5.6 trillion wiped off the map is quite dramatic. And Asia plays a big role on global markets as well. Asia, especially China, for example, has seen a vast majority of those gains. If you compare the Hong Kong index as well, the major indices in Hong Kong, I think there's like the Hong Kong 30 or something, which is, again, one of the major benchmarks for Asia, has been having substantial growth over the long term, but in this case is starting to see some sharp corrections. So as we've mentioned, U.S. markets are in a very interesting position. As we can see, the Fed has been raising interest rates. We've been seeing quantitative tightening rather than quantitative easing, with the Fed rolling off its balance sheet, as we'll talk about here in just a moment. And along with that as well, we've been seeing this kind of dichotomy between, even though U.S. markets are starting to sell off, that foreign markets, predominantly in Asia and in Europe and other regions of the world, they've been selling off even sharper. And it's interesting in places like Europe and Asia, for example, monetary policy isn't gaining strength in a sense. Sometimes they might have a higher interest rate, for example, in many areas of Asia, you have higher interest rates in the United States, but they're not seeing gains on monetary policy. Interest rates aren't going up to a drastic degree, right? Many of these areas are still seeing relief from central banks. So the U.S. is in a very interesting and peculiar situation comparative to, say, emerging markets or other global markets. But the major thing that I'm taking away from all of this is that it's important to get a clear realization that the world markets right now, whether it's being stated in the media, whether it's being stated by the officials in these countries, are already in an impending recession. This started in 2018 for a lot of economies. China's market's been had a bubble that's been popped since 2015. I remember I was watching that bubble at the time, and it actually sparked some fear in U.S. markets, but they continued on as well as European markets. So I don't mean to be rambling on here. My major summary is that the key thing to take away is that these markets have already been in recession territory, and that if there's going to be value in global markets in regards to equities, it's going to be in economies outside, most likely, of the United States. But again, it proves that right now the U.S. is still the pinnacle right now for finance in regards to equities. It is the safe haven right now. It's why they're so comfortable with raising interest rates. And again, there's a little bit of panic because of that, but I can tell you all, even with that, even though it's going to cause a slowdown in U.S. equities and in the general broader economy, it is very clear that the US is still the pinnacle point of finance right now. It just has so many advantages in a geopolitical spectrum that allow it to continue staying as the leader in regards to markets at the moment. And I wanted to go ahead and share this chart. It's a little bit outdated. It was a chart posted back in, I think it was an October article I found on Zero Hedge, but I just wanted to share this with you guys because I was reading a piece. I'll have to find it for you guys. I couldn't find the article this morning, but talking about the correlation between the Fed balance sheet here, or sorry, not just the Fed balance sheet. Sorry, my apologies on that. The global central bank balance sheet measured in US dollars. So compiling all of the assets owned by central banks and cash reserves as well of these central banks with world capital markets. So the entire correlation of global capital. And boy, does that paint a pretty clear picture there. So let me get this straight. When you start to roll off, these central banks who have just been piling up on bad assets like mortgage-backed securities and a variety of other equities. Japan, for example, has been the biggest buyer of ETFs out of anyone. Japanese, ETFs in this case, I think they own like 80%. When you start to have these central banks selling off their assets, you're telling me that this gets rid of the artificial demand and the prices go lower? I never would have thought. But anyways, I mean, it makes pretty clear sense, guys. I think, it's funny, many people who come probably to this channel and stuff, one thing that I always worried about when I would do investing and trading, I still do. It's something important, I think, to have, is to always be skeptical that you don't know what's going on, right? That you don't know what's going to come next, because there tends to be some very big surprises that come up. Some things that seem expected never come to fruition, right? That's commonly found a lot in the media. But the thing that I find funny, and I think a lot of people go through in their head, is that, watching a video here on the Data Dash channel, it's like, oh, you're probably missing the big picture. You're not getting the real look into how the world works. But it's so funny. I think people overcomplicate things, and it's not so black and white. It's very simple, and that we have the visuals right here. We have the explanation. It is simply understanding how monetary policy works, and that people time and time again forget that a change in monetary policy will inevitably lead to either a growth in the economy if you have quantitative easing of some sort, the lowering of interest rates, the printing of money, and the buying of financial assets, and or the opposite, where the Fed and other central banks are selling assets and rates are going up because they're having higher expectations for the economy. And it's not rocket science, because it goes back to actually real fundamental principles. When the Fed raises interest rates, it is not only just generally turning markets from a risk-on to risk-off narrative because it becomes more expensive to borrow capital, but you have to think about it in a business sense. If I can go out, for example, and what's happening now in the Eurozone, for example, in Europe, as well as in Japan, is you're experiencing what's known as negative interest rates. If I could go out and create a business that is, let's say, for example, not even making money at the time. Let's say it's losing 2% every year. But the ECB will lend me money and actually pay me to take that capital. They'll pay me 2% to borrow that capital, negative interest rates. Rather than me having to pay the bank, they pay me. I can actually operate that business. I can continue to operate a negatively returning business, a negative return on a quarterly basis, and I can still take loans from the ECB and be fine. And what that does is it encourages high risk incentives to engage in business practices that most likely will not remain profitable for the long term, most likely will go bust. And the worst thing of all is what happens when they raise those interest rates to 0%, to 1%, to 2%. Oh, God forbid, single-digit interest rates, right? Well, my business is going to go bust unless it's found a way to become profitable. And sometimes they'll use that as an argument. They'll say, for example, this is to incentivize innovation and turn unprofitable companies into profitable ones over the long term. But it tends to be that many of these businesses weren't good ideas from the start, and they shouldn't have been brought into fruition. That's why you have these boom and bust cycles, crazy growth and then crazy corrections in markets. And it's the same repeated thing. The Fed's created recessions 7 to 8 times in the past doing this. They're going to do it again. And, it tends to be that, as I've mentioned before on the channel, it's going to take about 6 to 8 to 12 months to really feel the pain of an interest rate hike. And we've had plenty of interest rate hikes. It's just a matter of time until we see that in the mortgage market. We see it in equities sharp enough. We see it in, people taking out everyday loans. It's quite concerning, guys. So very interesting stuff. Now, one thing as well that also can give a good sign about a impending potential recession across the board is the slump down in oil. Now, I think more than anything, some people might disagree with this. I think more than anything, this really has to do with continued overproduction. I was trading quite heavily and investing in trading back during 2015 and 2016 when oil companies were experiencing a bloodbath. There was a large amount of bankruptcies across the board in the United States because we produce oil at a higher cost comparative to OPEC nations, and the global economy was producing way too much oil, and no one wanted to make serious cuts. It was a standoff, as it always is. And whereas for some reason, I think with a few U.S. productions, levels of U.S. production shutting down and a few other cuts across the board that were actually legitimate cuts, I think there was some confidence resurging back into the oil markets. And with global growth as well, continuing as well back during 2016 and 2017, I think that kind of gave it a boost. But to be fair, oil prices were way higher than they should have been. And I think a lot of people still live in the kind of utopian idea that over the next decade that we're going to see oil prices over $100. I really don't see it. There is a lot of macro factors that are shifting here. And I can point to the chart. We'll go ahead and take a look at it here in just a minute. The important note that you have to take that there is a very low probability we're going to see triple digits for oil, not to mention just generally higher levels that frequently. I think we're going to be going back down to a range of oil that we've seen for a very long time, between $20 to $40 a barrel. We're really not far from that. That's what we saw back in 2016. Now, that's good for U.S. consumers, but it also is a signal that there's two things. A, there is a glutton supply, and there will be a glutton supply for a long time. Which, again, good for consumers, cheap prices. But that's bad for producers of oil. And along with that, it also might mean that we have a slowing level of growth on the global economy. And the third thing as well is that there just might be a lower demand for oil over time. I don't think we've seen that just yet, but with the advent of a lot of things like electric vehicles coming up, I think that will be a shift over the next 10, 20 years. But it takes a long time to get everyone over to electric. It's a matter of making more cheap electric vehicles and stuff. And as much as I like companies like Tesla, I don't know if I see that happening for the mainstream clientele until they can start making some of the cheaper models. But going on, let's go ahead and take a look at oil here. And I want to go ahead and take it here to the weekly, because I like to look at the longer term trend, guys. These trend lines tell us pretty much everything we need to know. Okay, so oil has been going into a descending wedge here. Who knows? Maybe 10 years from now, we're going to get some major breakout in oil. I don't know. But that is usually a pattern that usually leads to a breakout. But anyways, you can see here, we're talking about years and years here within price action. Really, since the turn of the 21st century in oil. So as we all know, we had the commodities boom back here into 2008, and then we had the collapse, and we've kind of zigzagged in between here. We held oil up here around $100 a barrel for a while. And then in 2014 through 2016, we had a very dramatic sell-off in oil. And it looks like we're repeating history here, right? So the major thing that I want to point to is that the trend lines will tell us exactly where things are headed, right? So I think maybe in the short term, for example, going into maybe January, we might be able to hold here at $40 like we did in the past. But the longer term target going into 2019 and 2020 is going to be going down even lower than where we went in 2016. We're going to most likely be going down to $20 a barrel. And that's very shocking for a lot of people. It's going to be shocking for the United States, for the energy sector, in regards to producing more oil. It's a lot of layoffs are going to come through, and it's very upsetting in that sense. I'd like to see the U.S. be energy independent. I would love to see us, if we're going to have fossil fuels, that we produce them here in America. I know we have the reserves to do it, but again, that's just sadly not how the world works in that case, things like the petrodollar. But in this case, the thing to take away is, to not doubt the reality and to see where the trend lines are leading us. In this case, it's leading back down to the same lows that we saw beforehand, around $25 a barrel, down all the way to potentially $20 a barrel. And this is not crazy, really, in the grand scheme of things. You can see here as we drag the line back, this is a price range we saw very frequently from the 90s and 80s, right? This is more rational to where oil should be. What's great about this, again, for the consumer is that we have to inflation adjust this, right? Back then, these prices aren't inflation adjusted, meaning that oil is getting dirt cheap. It is really, really cheap because the whole world stage is a producer of commodities now, right? You have a variety of emerging markets that are producing commodities. You have Russia, whose major export is natural gas and oil, right? So, and the thing I wanted to get to here with the talk about a lack of production cuts, I really don't think this has too much to do with global slowdown in the economy, as much as we are seeing a little bit of a slowdown. I don't doubt that. I think the reason that this is dropping is we never truly had real production cuts. We never really had a bloodbath. And maybe we did in the United States, but not in global markets. And we are going to have to see real, genuine cuts. The problem is that you run into something known as the prisoner's dilemma. This is a game theory aspect that you always have to take into account when global cooperation comes into the question, right? We hear this, for example, why nations very, very rarely ever come to environmental agreements that actually lead to serious, movement forward. Why, for example, trade agreements. This is another thing. Why is there this war of tariffs now, right? Where did this come from? Oh, it's because countries have been abusing tariffs even though they've stated that they're not going to. Nations, in a sense, they run into what's known as the prisoner's dilemma because they believe that there's a chance of a few different outcomes. We could both cooperate and take a partial sacrifice, meaning that they both engage in production cuts in the case of oil. And yeah, they take a little bit of a dent to their economy, but hey, at least their other partners are playing into the same role, and hopefully we'll see a rise in oil prices over time, so it becomes more profitable. Or you can do the other thing. You cannot cooperate, and you can try to sabotage your partner. And you're going to hope that they're going to do the heavy cutting in this case. They're going to cut off their production, and that you're going to get away with being able to produce the same amount with the higher price because they've cut some production, leading to a lower level of supply. So that's exactly what's happening here, guys. We've, I think, had not only OPEC nations very concerned that they're losing their leverage on a global stage, but you also have most economies playing into human nature, trying to see what they can get without having to put any effort into it. That is how global markets work. That is how geopolitics works when it comes to commodity-based production. So again, it's going to play out like it always has, and it's going to end up hurting both sides because they're not going to cut. And that's where you get actually the other scenario where both parties try to sabotage one another, not producing production cuts, and then the market corrects it. The market comes down and says, hey, look, you're both losing now. None of you produced, or none of you cut productions. So in this case, it's history. It's repeating itself in this case. So I think what you're going to see is oil over time bounce between these levels and go back into this channel, what we've seen before. And maybe if oil still plays a role, it would upset me if it's in 2030, if it's still this big of a commodity in our world, but I guess it's always ran the world. I would say that, maybe then we can have some kind of breakout longer term, but I think we're going to be in this channel for a very long time, unless you see something like hyperinflation or oil demand comes back up due to crazy global growth. I don't know. I think we've seen a lot of growth in the economy, and if oil is this abundant, who knows, we might not see it escape that channel for a very, very long time. So it's an important thing to watch, guys. I know a lot of you out there probably keep up with just crypto, or maybe you watch a little bit of equities as well, but it's important to watch these commodities because they do play a role. When oil goes from $40 a barrel to $20 a barrel, that's a huge precedent. It doesn't seem like much on the chart, but it is a huge game changer. And same goes from oil going to $40 to $60, So every dollar counts in this case. For different actors, for consumers, it's a dollar saved. For businesses, it's a dollar lost. So, again, it's important to take that in mind. I think it's fun. Not to mention, you can trade these markets if you want to trade commodities. I think it's one that you shouldn't shy away from because, in this case, if you saw this line of resistance here, Oil made it very clear. And look how much it's dropped for a commodity, from the mid $70 range down to the mid 40 range. Very, very intriguing for a 3-month trend here. That's not a bad trade if you can get it. Going on here to talk about equities. Want to be fair here. I know I've been rambling on a lot today, but I want to spend some time to go over here and take a look at the major indices. And to be fair, point out that we've got a little bit of a green day here. This is very nice to see here in regards to price. We'll have to see if by the end of the day it rolls over or if it continues higher. Definitely looks nice here. I like to see that we're seeing a little bit of optimistic price action because I've been definitely considering a trade on the Russell 2000. I've been watching the Russell for a while, and I'm taking a look at the daily here. And it's down towards my range where I was starting to get interested. So we might get a little bit of a rebound play with all this dramatic sell-off. I mean, taking it into the monthly here. These are the small caps. You can see here, this is a line where it not only served as previous resistance, but started to turn into support here. So maybe we can start to get a little bit of support here. If not, I think the Russell's heading back down to where it was back in 2016, down at these lows around the 1100 point range. But again, we'll talk more about equities in the future. Market sell-off is still well into existence. Russell is down 16.72% for the month. Worst month since we've seen back in 2008. Very, very bloody month here, folks. I wanted to actually see if I can get the actual percentage. Yeah, last time we saw this kind of double-digit moving in price, or at least to this range, was back in, I think this is November of, or no, it was October of 2008. 20%. Wow. But again, quite expected, guys. We talked about it. The rules are changing. Monetary policy is changing. And it doesn't matter what market it is. It doesn't matter what central bank it is, what currency they're changing the rules for. It's all the same game. Just different faces and different names, but always by the same rules. Anyways, that's it for the video. Thank you all so much for watching. I hope you guys are having a fantastic day. I hope you guys had a wonderful Christmas or a wonderful time celebrating whatever holiday you do. And wherever you guys are, I hope you're enjoying it with family and friends and not getting too caught up on crypto, stocks, or anything else. Just sit back, enjoy the ride, keep a good eye on markets when you get the chance. But until then, thank you all so much for watching, and I'll see you all in the next one. Stay tuned.